A very warm welcome to the fourth episode of InsPIRE Economic Edge. I'm Debesh Roy, Chairman, Institute for Pioneering Insightful Research Private Limited, a research and consultancy firm dedicated to economic development and climate change policy advocacy. In this episode, beyond 7.4%, can India convert fast growth into real value? I'm going to analyze the first advanced estimates of India's GDP for FY 2025-26. Real GDP growth is projected at 7.4%, an acceleration from last year and the strongest globally. In a world grappling with geopolitical tensions, trade fragmentation, and uneven recovery, this reaffirms India's role as a key engine of global growth. In fact, the World Bank's Global Economic Prospects January 2026 has upgraded India's growth estimate for FY 26 to 7.2%, from its June 2025 estimate of 6.3%. But as I will argue today, headline growth alone does not capture the full economic story or the strategic choices that lie ahead. India has secured growth momentum in a challenging global environment. The real task now is strategic. How we convert the momentum into durable income growth, stronger fiscal capacity, and long-term competitiveness. The shift from growth to strategy is what today's discussion is about. Let me begin with what I call India's current growth paradox. Real GDP growth is projected at a robust 7.4%, yet nominal GDP growth is estimated at just about 8%. For an economy expanding this fast in real terms, this is unusually low. In effect, the implied GDP deflator is barely 0.5%. Low inflation is, of course, a positive. It reflects improved macroeconomic management and a strengthened economic stability. But when the gap between real and nominal growth becomes this narrow, it also points to deeper structural signals. Nominal growth is what ultimately drives corporate revenues, tax buoyancy, wage growth, and debt sustainability. As the chart shows, the gap between real and nominal GDP growth has been steadily narrowing over the past 5 years. The trend deserves close policy attention because sustained high real growth without commensurate nominal expansion can constrain incomes, investment incentives, and fiscal space. The most policy relevant signal from the estimates lies in nominal GDP. At just 8%, nominal growth is unusually subdued. Across sectors, pricing power remains constrained. Agricultural prices are soft. Manufacturing firms are expanding volumes in competitive markets with thin margins. Services growth is strong but concentrated in regulated and public linked segments. The result is an economy that is efficiently producing more but earning less per unit of output. This matters because nominal GDP drives tax buoyancy, debt sustainability, and income perception. Real growth improves welfare in theory, but it is nominal income growth that shapes spending, investment decisions, and economic confidence. Reforms must lift nominal incomes to sustain growth. On the production side, real GVA growth is estimated at 7.3%, a rise from 6.4% in the previous year. So the production side of the economy is clearly gaining strength. But to understand the quality of this growth and its implications for incomes and inclusion, we need to look beneath the aggregate number at where the growth is actually coming from. The services sector is projected to grow at 9.1%, driven by financial and professional services at 9.9%, public administration and defense also at 9.9%, trade, transport, tourism, and digital services at 7.5%. This aligns with the World Bank's assessment that India's services exports, especially IT services and business services, remain a durable source of growth and resilience. Manufacturing and construction are projected to grow at 7%, supported by infrastructure spending, steady domestic demand, and export diversification. While manufacturing has risen sharply from 4.5%, construction has seen a drop from 9.4%. However, despite broadly normal monsoon, agricultural growth is estimated to decline from 4.6% to 3.1%, and weak price realization has constrained nominal farm incomes, reinforcing the disconnect between output and earnings. This asymmetry between dynamic services and subdued primary sector remains a central challenge for inclusive growth. Sustaining high growth will now require rebalancing by strengthening manufacturing and farm incomes so that services-led momentum translates into broad-based prosperity. Another important feature of the first advanced estimate is timing. Growth in FY 2025-26 is front-loaded. Real GDP growth in Q1 and Q2 were very impressive, 7.8% and 8.2% respectively. RBI estimates Q3 and Q4 growth at 7% and 6.5% respectively. Real GDP growth in the first half is 8%, but would moderate to around 6.9% in the second half, reflecting base effects, fiscal normalization, and global uncertainty rather than a loss of momentum. Despite weaker than expected nominal growth, fiscal stability remains intact. The level of nominal GDP at rupees 357 trillion is slightly higher than budgeted, largely due to upward revisions in the previous year's base. This has produced a cushion to the fiscal arithmetic, allowing the government to remain on track with its fiscal deficit target of 4.4% of GDP, supported by higher non-tax revenues, including a stronger RBI dividend and continued expenditure rationalization. However, the more important structural shift lies on the demand and investment side. On the demand side, the picture is mixed but instructive. Investment is holding up well. Gross fixed capital formation is projected to grow by nearly 8%, and importantly, nominal investment has also strengthened, which is a positive sign. Private consumption is growing at around 7%, but rural consumption remains subdued due to weak agricultural incomes. Per capita consumption growth at 6.1% suggests income gains are real but uneven. Government consumption continues to play a stabilizing role, especially through state-level spending. Once again, the pattern is clear. Real demand is resilient, nominal demand is constrained. Public capital expenditure continues to play a critical anchoring role. While government capex is expected to crowd in private capex, the same is not happening to the desired extent. Therefore, there is a need for a meaningful revival in private capital expenditure, supported by stronger corporate balance sheets, improved bank asset quality, and rising capacity utilization in key sectors. Importantly, this revival is possible if accompanied by higher corporate spending on innovation, technology upgradation, and research and development. This shift matters because investment-led growth backed by R&D and innovation is precisely what strengthens productivity, pricing power, nominal value creation, and global competitiveness. In this sense, this transition from a public investment-led recovery to a broader investment cycle combining government capex, private capex, and innovation-led expansion could mark a positive inflection point in India's growth story. In global perspective, India's macroeconomic position remains relatively strong. The World Bank's Global Economic Prospects January 2026 highlights India's improved macroeconomic stability, healthier corporate and banking balance sheets, and ongoing structural reforms as sources of resilience relative to many emerging market peers. The World Bank estimates India's growth in FY 26 at 7.2%, retaining its position as the fastest growing large economy in the world. While the world economy is estimated to grow at 2.7% in 2025. The US, EU, Japan, and China are estimated to grow at 2.1%, 1.4%, 1.3%, and 4.9% respectively. Yet, as India, a $4 trillion economy, moves towards becoming the world's third largest, scale alone will not be sufficient. To sustain real growth in the 8% range over the medium term and to strengthen nominal momentum, India must deepen reforms that unlock private enterprise and global capital. This brings two priorities to the forefront. First, improving the ease of doing business, not just through regulatory simplification, but through faster approvals, contract enforcement, policy predictability, and lower compliance costs. Second, further liberalization to attract faster and more stable foreign direct investment. FDI is not just a source of capital, it is a carrier of technology, managerial practices, global market access, and higher value production. A stronger and more predictable investment climate can help shift India's growth from being volume driven to value driven, especially in manufacturing, global services, and green technologies. India is growing fast in real terms. Public investment remains strong. Private capex needs to revive. Corporate investment in innovation and R&D needs to gain momentum. Services exports continue to anchor external resilience. Yet, the estimates also underscore a key strategic challenge. Growth must generate stronger nominal value through productivity, pricing power, and income expansion. India's reform agenda must advance cohesively, linking fiscal consolidation with growth, financial deepening with investment, energy security and green energy transition, trade liberalization with export competitiveness, industrial modernization with AI-led innovation, agricultural transformation with income resilience, and urban renewal with job creation under the framework of cooperative federalism. The role of the government must continue to evolve from controller to catalyst, creating the conditions for enterprises, competition, and innovation to thrive. Ultimately, India's transformation is not just about becoming a $30 trillion economy by 2047. It is about defining a development model that combines scale with equity, technology with trust, and growth with purpose. As India advances towards Viksit Bharat 2047, the message is clear. Reform is a continuum, transformation is a journey, and the horizon of shared prosperity is firmly within reach. Thank you for tuning in to Inspire Economic Edge. Please subscribe, share, and like this video. Stay informed, stay inspired. Namaskar.